Hello, and welcome back to the Wallfacer Labs podcast. Today's guest is Sefton Kincaid, the co-founder and CEO of Cicada Partners. Cicada provides industry-leading third-party underwriting and pool management on DeFi protocols, risk structuring, and institutional risk advisory services. Sefton, welcome to the show.
Thanks, Ryan. Nice to be here.
So let's hop right in. So you've been working in credit for, I think, 14 years now, about 2.5, 3 years in crypto. What initially drew you into the world of credit rather than, other parts of finance?
Yeah, I kind of stumbled into credit. It was kind of a product of doing a bank rotation right out of school and studying for the CFA. And it was really post-financial crisis where lots of asset manager jobs were hard to come by. And yeah, I basically got my feet wet by doing some cross-currency hedging for a credit fund that made me kind of open my eyes to this other world of market inefficiency, and was a big, I would say, advocate or student of a lot of the kind of Buffett school of value-based investing. And so I had a lot of kind of learnings pushing me towards where is the most inefficient market that you can find to research. And it was, at that time, it was much more in the credit side of things than it was on the equities. So that naturally led me into more credit side of the capital structure, researching mostly initially on high yield levered loans, a little bit of convertible bonds. And I guess the rest is history.
So you don't see, I think, a lot of people from traditional credit get into crypto credit. What was the thing that initially drew you into these markets?
Well, I think it was kind of an extension of the first answer, really. There's this, I think it's fair to say, lots of inefficiencies across the whole crypto space. And I've been a kind of just in the personal account investing in Bitcoin and Ethereum and the side. And then when I saw kind of really the growth of stablecoins and really better understood kind of the value proposition of the payments ecosystem back around 2017, I got very interested in kind of like some of the early DeFi primitives from Maker and Compound. And that led me to networking in the space and kind of just fell into looking at Centrifuge and Maples. And then later I also saw TrueFi, but I was kind of more focused on Maple at the time. And I thought that look, if something like a Maker DAO or Compound could grow, what that meant for under-collateralized lending was, I think it was a kind of a natural extension. And so I was looking at these tools, and in the TradFi world where costs are constantly being cut and consolidation is a very real trend in the traditional asset management space. And I saw these tools as maybe a new tech stack to reduce back and middle office costs.
Well, that's a good segue to, I guess, how I first came across you and your team at Orthogonal back in the day, which is that we were kind of theoretical competitors, at least, underwriting a lot of the same borrower names. My team at TrueFi, you guys as probably one of, if not the largest underwriter with the team at Orthogonal. How did you initially get involved there? And I guess, even kind of more specifically, the point around the increased efficiencies of kind of the crypto rails. How did you guys quantify some of that as you were looking to join the team over at Orthogonal back then?
Yeah, so I joined I joined Orthogonal. It was really, I was in the Maple ecosystem, kind of advising on the side on the underwriting side, poking around, figuring out is there an ability for me to launch my own pool? And then ultimately got introduced from the Maple team to the head of Orthogonal trading at the time, who wanted to seed a credit pool. And he ultimately trusted me, and I came with some commitments. I want to, have a certain amount of budget, hire people, do it right, and kind of professionalize a credit desk. And he gave me the bandwidth to do that. So, it was kind of a blanket kind of mandate to go out and build a business. And so I thought it was kind of a great opportunity, very entrepreneurial, which was something I was really looking for. And see where it goes, which ultimately it beat all of our expectations very early on, and then defied that in the opposite direction later on.
Yeah, maybe we can get into the up and down there in a bit. But
Yeah.
one other thing that I kind of always go back and forth on, and I think you coming from the traditional side will have a good understanding of the efficiencies that a DeFi protocol can bring to the underwriting, the origination, deployment, repayment, that whole stack. When you were at the time underwriting on Maple and now looking at doing the same on TrueFi, how did you think about those efficiencies? Like where are the bulk of improvements happening from the perspective of the underwriter?
Yeah, I would say the biggest efficiency is on the settlement and reconciliation side of things. From an asset manager perspective, you have this laundry list of intermediaries that exist because of past bad actors. And they exist for a reason, from auditors to fund admin to custodians, et cetera. Non-custodial protocols inherently come from a different perspective and don't require those kinds of middlemen. So looking back on the 2 years I built the team with orthogonal credit, our margins we quantified our margins as basically on a fully cost-baked basis. They were effectively double what the at-scale asset management companies are. Public at-scale asset management companies are. So this is a team of 3. Now you could say we didn't really have any sort of marketing budget. That wasn't really our bandwidth. So maybe that's, it depends on how you spend money on distribution. But from a pure operations standpoint, we could effectively outsource a lot of the trust assumptions to the blockchain or the protocol layer, which resulted in a pretty attractive business model at a micro scale.
Yeah, absolutely. And do some of those savings come about because the protocol takes on or sort of internalizes some of those costs that otherwise may be with an asset manager, or that's sort of excluding some of those considerations? Your additional margin is just that much better than what you could get in the traditional realm.
Yeah, it's a good question, which I've thought about a lot. I would say there's 2 perspectives. There's the institutional perspective, and then there's a retail perspective. If you take out the marketing retail expense, I think the incremental costs, once say these protocols are well established, are not really a factor on the protocol side of things. Now that requires a certain amount of scale, but the scale to get there is we're talking in tens of millions versus billions in the TradFi sense. So yeah, I think if you're talking about using, I think, open source protocols at an institutional level, which I think I'm hopeful that this is where it's going to go eventually. It's going to take a while. That's kind of, I think that there's some real cost savings to be had there. Now, the problem is the institutional space has been built up around the custodian being the central operational nexus of these asset managers. So the reason why, one of the real key kind of drivers of creating Cicada is that we think that there's a good reason for kind of a new entrant into the space that's purely non-custodial and purely DeFi, because it's going to take a while for traditional asset managers to be comfortable with the tech risk because they just don't understand it at all. And so, yeah, it makes sense for, it's kind of like a classic innovator's dilemma.
Absolutely. And that's always been one of my big qualms, I guess, in terms of, when you look at the efficiencies provided by on-chain, transparent asset management versus the, I guess you could say, setup or additional compliance cost for some of these traditional asset managers. At the moment, I think maybe their calculus is that some of the negatives may outweigh the positives. And so I guess getting to that point where either one, the benefits are more clearly explained, or B, some of those compliance, setup hurdles are lowered. That's when I kind of imagine we'll see more of those traditional entrants into the space.
I mean, look, if you've covered your cost basis, it's on the traditional side of things, it's a sunk cost. You're not incentivized to take that risk to move on to a different tech stack. And so I think it's going to require crypto native companies to see that opportunity. And it's also going to require just general maturity of the software. Like, we have to be real. We have to be realistic. Like, seeing hundreds of millions of dollars being lost to, all sorts of nefarious actors is not going to, is just, no C-suite is going to write off on, jumping in, regardless of whether the actual underlying risk is real or not. It's just the optics of it all are going to take time to play out.
Totally. So I guess going from there, Something that I wanted to do in this conversation is actually walk through the past, present, and future of crypto credit markets. Where we are today in 2024 feels like we are maybe just getting back to a place of the last 2 years of all of the blowups have sort of flushed out of the system. And we're at a point now where this activity can start coming back on chain in a meaningful way. But to understand where we are today, I wanted to go back, as far as we can, just to get a whole picture of the market. And in prepping for this, it seems to me like the crypto credit markets basically started in 2018 with the launch of Genesis's lending division. Around that same time, we saw BlockFi and Celsius launch and sort of come to prominence a bit in 2018, a little more so in 2020. Babel and Nexo also around that period of time, and then TrueFi and Maple in 2020 and 2021. Am I kind of correct in that? Was there a market here before Genesis, or do they really kick this off in 2018?
I mean, I think there's always OTC markets in the background when you have whales involved, but that predates me, to be honest. I would say that the true launch of the asset class started with Genesis, and I mean, you see it in the Genesis public numbers. It's like it's radical how quickly they grew from very low volumes to effectively we have total. I think our total lending market sizing was something for the 4-year cycle was something like 150 to 200 billion. That's through the cycle, but they started from less than 10 billion in year one. Very quickly, radically grew from that.
Yeah, I remember pretty religiously reading those Genesis quarterly reports they used to do, and I think they went from 7.6 billion in originations per quarter at the end of 2020 to then peaking at 43.7 billion in 2022. Obviously, I remember at TrueFi, and I'm sure you guys at Maple just being staggered by those numbers and, wondering how we could ever get to that point. But despite that impressive growth across Genesis and some of these other platforms, I think the downfall was basically just as violent. As you look back at that time, the Celsiuses and the Genesises and Babels, what do you think was the cause of some of that unwinding and the ultimate failure of those models?
I think I'm of the view that banks or neobanks are really one crisis or asset liability mismatch away from being insolvent. I mean, the traditional bank doesn't work without deposit. I mean, we have to be real. The traditional bank doesn't work without deposit insurance. We found that out very quickly last spring, about a year ago today. And I mean, that doesn't work in traditional markets, let alone in crypto, where everything is even more volatile. So I think one of the real problems was there needed to be crypto markets are extremely inefficient because they're so fragmented between DeFi, between CeFi, between countries, between coins, between derivatives and spot. There's lots of opportunities for making market neutral trading profits. So that makes it a space in which you can that needs capital efficiency, which generally comes in the form of credit. Meanwhile, you had retail who didn't really understand that asset class, wanting yield-bearing assets, and the biggest asset of which has no yield, except if you put it, in the case of Bitcoin, if you put it in a black box, you can pretend like you're wrapping it and generating yield on your Bitcoin. So VCs caught wind of this kind of business model and ultimately, I think, made the bet that that they should fund these businesses, which they did. Two handfuls for these businesses. There were many of these kind of neobanks, and I just think that the business model inherently is flawed because they'll never get deposit insurance. Let's be clear. And so, I think ultimately you have a problem of kind of a bad business model with also some misaligned incentives that really kind of was the key catalyst.
Yeah, that's a good framing for thinking about some of these businesses like a Babel or a BlockFi, where in reality they were lending businesses sort of dressed up or valued as neobanks, which at least in that time period were very highly valued. And I think something that I certainly learned in this period is that, lending is not necessarily grow at all costs VC type of business the way that maybe other categories of fintech might be, just because the risk involved in lending can be so astronomical. And I think many people don't quantify it, especially at the time from the lender perspective, just because it was a guaranteed, hey, you're going to get X percent, when the reality of the other side of the business was, they're trying to balance all of these borrowers. They're trying to hedge for defaults. They're trying to, expand into other categories of lending as well. And so, I think maybe a lot of that got conflated behind the scenes.
It's an old man's business, or woman for that matter. It's an experience. You don't make your money in lending by playing one cycle. It's who's at the table longest, not who wins an individual pot. And yeah, it's incongruous with, I think, a lot of crypto and the way VCs view the world. Well, not all VCs, I should say. But yeah, I agree. I mean, I think of any sort of lending startup needs to take a stair-step approach, grow, pause, evaluate the risks that you've taken, tweak your models, and then once you get comfortable with that, then grow again, as opposed to just kind of like reinvesting in growth at all costs. It's kind of a fool's errand in the space, I think.
Yeah, and I think at least for some of those businesses, what I can presume kind of happened is that because they saw these continuously incoming deposits, they felt the need to keep growing, which meant continuing to concentrate with the largest borrowers, which happened to be the Alamedas of the world or the 3 Hours of the world. And then, we all know how the story goes from there.
Yeah, you just get this self-referential cycle of lending, which, ultimately panned out. I think the other big part to mention is that, I think a lot of these neobanks, they had a very real mission creep from their original business model. And you saw this really in 2020, almost, I would say 2020, where the docs in some of the CeFi institutions started to change. You could tell that one of them blew up. I forget what the name of the lender was, but one of them blew up because they were basically lending unsecured. And the point being is, these entities went from being over-collateralized lending institutions to the over-collateralized yield that you could get in crypto went to very low single digits. And to retain or attract new depositors, they needed to basically reach out the risk curve. So you had an organization that was now moving from over-collateralized lending, which is a totally different skill set, versus under-collateralized lending, and really not hiring or having the risk mitigation internally needed to underwrite that risk. So I think there was a lot of mission creep over time in these organizations that just didn't keep up with the times.
Oh, well, since you bring it up, what are, you would say, the kind of biggest differentiators in the skill set there? Just more of a credit focus on the under collateralized side, or something else?
Well, on the under collateralized side, we look at what we do on the market neutral lending side as really more of a fund-to-fund type analysis approach to credit. And it's basically you're underwriting the manager's return profile and drawdown risk and risk controls, internal policies and procedures to generate yield, which is very different than I'll accept XYZ collateral at X% over the value of the loan, and I will liquidate you at Y. That's a very simple business, so long as you have a view of the volatility of the collateral and your risk thresholds. It's a very streamlined business, whereas having a fund-to-fund kind of portfolio investment approach it takes a completely different skill set, ultimately. Something
a lot of people learned in the last couple of years, I suppose. So around the time that Genesis was at its peak, we also saw the rise of DeFi platforms like TrueFi and Maple. And I think at the combined peak of TrueFi and Maple, there was about $1 billion of outstanding loans in May of 2022. I think these platforms had a lot of benefit for the borrowers and maybe some of the managers that came on around that time. You were someone who was underwriting these loans, interacting with a lot of borrowers, interacting with a lot of lenders. What was it that TrueFi and Maple brought to the table that appealed to borrowers or folk like yourself who were actually underwriting these loans?
Yeah, I think the common value prop that we got from borrowers was really fixing the tenor at out the curve versus an open term that most of the CeFi desks had to lend at, given that most of the assets, most of the liabilities that they had at the time were retail deposits. So yeah, I think tenor was one thing, which ultimately leads to locking in a rate. And as we know, crypto rates are extremely volatile. And so borrowers or any business for that matter likes to have a certainty on the cost of capital. For lenders, I think the more sophisticated ones like these platforms, because it provided a way for them to actually know where the yield was actually coming from. Not to say that all lenders had a good understanding of what yield meant when you lent to Alameda, for example, but you at least didn't have you weren't trusting a neobank to then generate yield through unknown a bunch of unknown interconnected strategies. Maybe Alameda was a bad example of that to compare to, but you get the point. It's I think for the most part, right, like on-chain lending, while there were a few hiccups, it worked relative to CeFi. And yeah, I mean, lenders certainly took it on the chin in a couple instances. But if you strip away, if you look at the aggregate statistics, which we've looked at pretty closely over the last 6 months, if you look at default rates across DeFi under collateralized lending to market makers, they are basically just over 2%, which is pretty remarkable given the yield that is on offer in the high single digit to low double digit at the time.
Yeah, I would very much agree with that. And I think the transparency to the lenders probably goes a little bit underrated in that scenario. I think something that I appreciated, at least with some of the pools on TrueFi, was that as the credit crunch kind of started to happen in 2022, there were people that wanted to get capital out, but that couldn't just because there wasn't liquidity in these pools. But it was very easy for us to point and say, hey, this Wintermute loan is due back in 26 days. There will be $60 million available at that point, and you are entitled to some piece of that. Whereas I think at some of the other venues, you truly just didn't know who was on the other side of the borrow. It was this black box that you talk about. So I do think probably the platforms like TrueFi and Maple were a bit underrated, and I don't think it's really been published too widely, at least how the default rates have compared to, I think what happened at the CeFi platforms, which in many cases just, I don't know what the recovery on some of those were, but the platforms are no longer in business. So I think that kind of wraps up the past of crypto credit markets. And I would consider the present to be the period kind of from May 2022 to about now, where I think we're getting into the future. And May 2022 pretty much marked the top of this market. Actually, in going back and researching this, I saw that that May 9th was both the peak of on-chain loans and the day that Terra depegged to 35 cents. So I think it was a pretty pivotal moment in the history of crypto credit markets here. As we approach now basically the 2-year mark of that point, what's been happening for the past 2 years in crypto credit markets? Like, have things evolved? Have they stayed the same? Have they devolved? How would you define the last 2 years?
Yeah, I mean, I think of crypto credit markets in basically two buckets. Like, you have the crypto native side of things, and then you have what's loosely becoming known as like the RWA, or like I like to call it the non-crypto side of things. I mean, post Terra Luna, effectively, the crypto credit side was a race to zero. I think, that vertical one, it didn't make sense because of obviously the fear in the backdrop, the background, but also even very recently, I think there was a big disconnect in lending in that space because of the exchange risk, because Binance had so much market share, and I think I was very worried that this vertical might not exist if Binance became such a dominant market share player. But I think that's kind of removed. I think the asset class has really de-risked from the growth of, or the advent of, new off-exchange solutions from Copper and Fireblocks, as well as just generally what's going on at Binance. And you can see it in exchange volume becoming more fragmented in general. So I think that's really kind of accelerated over the last six months on the crypto native side of things, to the point where I think the industry has de-risked materially. And now with the halvening and retail interest and all-time highs back to where they are, and crypto DeFi, CeFi being as fragmented as ever, I think there's I think I hate to say it, I think we're back. But now is, there's still not much, if any, unsecured lending. There is some going on. And now it's more of like, okay, what's the best business model, and can we price the risks appropriately? given I think what the knowledge that we've learned through the last cycle and the data that we've accumulated.
Pricing risk is definitely a conversation we can get into, but
yeah,
you mentioned Fireblocks and Copper and some of those kind of custodian or hybrid solutions, and even the exchanges. But why haven't they gotten more into the business of lending? They kind of seem like the natural lender, which I guess would be more like a prime brokerage type of role in traditional markets. And maybe they have gotten more involved, and I'm just not aware.
The wallet or the custodian, because I guess you kind of have, they're kind of one and the same. I mean, Copper is part wallet, part custodian, whereas Fireblocks is, if you talk to them, they're kind of adamantly not wanting to be a custodian. And so my point is, I think we are among multiple industry participants who are trying to figure this out actively with those service providers. And then you can throw in the prime brokerages of the world that are capital constrained as well, and they want to figure out a solution that makes sense for both sides of the market, not just borrowers but also lenders. So I think there's a roadmap where I think there's different flavors of risk based on the size, the tenure, the type of strategy you're running, that you can ring fence risks in different ways. So I think, fortunately for the market, I think there's going to be multiple solutions to solve this problem. The higher quality borrowers will be able to get access to unsecured credit. The mid quality borrowers that have more targeted strategies will be able to take advantage of a combination of I think either prime brokerages, new DeFi primitives, or some sort of hybrid strategy using these off-exchange products like Copper or Fireblocks.
Something else that makes me think of is that in the last cycle, it does feel like a lot of these credit risks could have been removed if some of the lenders perhaps talked to each other more. Is that something that happens a lot within traditional finance? Like, does one prime brokerage kind of talk to another and get an understanding of a counterparty's shared risk, or is there also no communication in that realm?
Oh, no, it exists. Yeah. I'd like to think that one of the mistakes that we made, actually, we helped a peer not make it. But yeah, I mean, we ultimately we don't benefit from our peers blowing up. We benefit from the growth of the market. There's particularly what happened last cycle. Like, I'm not like in it to be anti-competitive and wish for, have some sort of blow up at our competitors, because ultimately what did that do over the last 18 months? It resulted in this vertical basically evaporating. Yeah, it's in no one's interest to see those kinds of shenanigans come back. And yeah, ultimately, to your point, like the whole 3AC fiasco, I think is really the case in point there. We asked a few more questions, and ultimately never got any sort of answer. Then asked some other people, like, did you ask this? And they're like, oh, no, I didn't think about that. And it's like, well, okay, there's a reason why this company has a $3 billion balance sheet. It's because nobody did any sort of diligence, and they just, thought that they were a bunch of smart guys.
Yeah.
So I guess to unpack that a little bit more, I heard in 21, there was a lot of like talk in the market about like, oh, they have a huge balance sheet. They're good for their money, good for it. Right. Whereas it's like, okay, well, where's that money coming from? Understanding, is it profits? Where do the profits come from? And unpackaging that was a lot of the risk. And that goes back to my previous point on like, what's the difference between under collateralized and over collateralized risk analysis. And it's understanding, kind of the attribution of returns and whether that's sustainable over multiple cycles, and what market environment that just doesn't work in, or were they just lucky? Right. That can be a lot of it.
Well, here's to more communication in the future. Something else you mentioned that I think is a perfect way to start talking about the future of where this market goes is the pricing of risk. I agree that probably last time around, a lot of people would have said that many of these borrowers were borrowing at rates that, no credible, that didn't have the pressure of lenders would lend to them at. How do you think about this time around the change in the pricing of risk for some of these borrowers? Are there new floors? Have lenders changed what they're looking for? How do you think about the pricing of risk, today in April 2024?
Yeah, I mean, I think it's it's gone from in April of 22 to being radically mispriced to being radically mispriced in the opposite direction. When we look at all the defaults that happened in the space and look at total underwriting volumes, we think that conservatively, the default rates across the full cycle are like 8%. This is including CeFi, with the perverse incentive structure that we mentioned. That's akin to a single B type credit probability default profile. If you look at the secondary trading of bankruptcy claims, that gets you to a loss given default number that I think is pretty akin to, again, a single B type high yield credit risk profile. So if you look at that as kind of an analogous market in TradFi, yields are in the 7 to 8% to lock up 5 years in duration, whereas you can lend open term at 15% to high quality borrowers that I would say do not have an 8% probability of default. So I think easily there's, from a risk adjusted basis, there's hundreds of basis points of alpha disconnect in pricing of this vertical. Now that comes in face of really elevated funding rates in crypto. So whereas it looks really attractive to TradFi, the inherent token based yield and the funding based, which is real yield, in crypto is going to compete versus this credit vertical. But as we saw last cycle, funding rates will stabilize over time, and I think credit will have its day throughout the full cycle of crypto.
Well, that might be the answer to my next question, but what ultimately gave you the conviction to stay in this kind of on-chain credit market versus, the endless possibility of other things you could do?
Yeah, it's a good question. I mean, I think it gets back to can these protocols really cut costs to asset managers longer term, one, and then two, I'm a enormous believer in the growth of stablecoins longer term. And so I think building a business that basically plugs into is a levered bet on the growth of stablecoins, or is an adjacent bet on stablecoin growth, is a smart thing to do. So yeah, I think it's the combination of the one, secular trend, and two, kind of adding value by reducing costs to lenders over time that we're trying to piece a business together and grow with the secular trends.
So we didn't actually talk too much about what Cicada Partners is, but when did you start the firm? And maybe you can share a bit more about kind of the founding thesis and what you guys are working on today.
Yeah, I mean, that's part of the founding thesis I just mentioned. So Cicada Partners, three co-founders, former team that managed a pool on Maple, as you alluded to earlier. And we have really two initiatives. One is to structure private asset-backed deals with the Atlantis protocol, and that's really key to our thesis of reducing costs to create these lending verticals on chain. And then our second initiative is really more catered to the crypto native side, with that can be really summarized in the forum posts we put on TrueFi in the recent weeks.
So actually, you mentioned some of the asset-backed lending that you guys are doing on Atlantis. Could you talk a little bit more about that too, and kind of how you're structuring some of those, and maybe the nuanced difference between some of those asset-backed deals and the crypto type of stuff you look at?
Yeah, so the asset-backed side duration is going to be a little longer, about 6 months to a year. We are structuring most of it, but not all the deals, in more akin to a typical securitization structure, which basically means you have a ring-fenced special purpose vehicle that's housed in Delaware that owns the underlying collateral, and that becomes the borrower. And the really target borrowers in that vertical are more originators of trade finance, SME lenders, any sort of like intangible asset that can be factored into an SPV is kind of the target audience. We do also loans to more growth businesses that need working capital financing. So there's really two kind of separate structures there, but it's much more, I would say, the legal stack is much more focused on the US, because that's where we trust the legal system there on the collateral side of things versus on the crypto native side of things. The analysis is less on the underlying collateral, as we mentioned, and more on the underlying the business and strategy.
How have you found the appetite for some of these longer duration RWA quote unquote type of opportunities? And I ask because, I think all of our platforms have tried to move into more of these RWA type assets. But I think that the yield, given the duration, has been a turnoff for the crypto native crowd. And where we have seen success has often been because there is a large funder, like in the example of, Block Tower's deal on Centrifuge that is, entirely in the senior funded by Maker. So that's kind of the one exception. But other than that, we've seen these kind of struggle. Actually, just this morning, we saw another default on Goldfinch, which I think has kind of been the number 2 in this RWA category. So how do you think about that type of lending on chain?
No, I think we're kind of stuck in the middle between traditional lenders who I think would have most interest in this value proposition, maybe not really wanting to touch the crypto side of things and understanding the risks there. And it takes time and education there. And then also, your point is valid on the crypto native side, not appreciating or not seeing as much value in the yield. I mean, I think that a lot of the Goldfinch stuff that has happened was underwritten at a very, very different time in the market, obviously different team. And so I'm fairly confident we can do a good job on the underwriting side. But to your point, it's not a retail lending focused vertical. It's more of an institutional focused vertical that we're building out longer term. And to that point, one thing we're doing, and I think is really necessary, is I think one of the things borrowers have been averse to working with DeFi protocols is that they don't want to touch the actual crypto because they don't understand the wallets. They don't know what to do in their back office. One of the many attractions to us with Atlantis is they have a regulated French entity that has a money transmitter license. So they have the ability to abstract, if needed, for borrowers and eventually lenders, the wallet complications of interacting on chain.
I had no idea. So that's like a French equivalent of an MTL, or they have a money transmitter license?
Yeah, so it's like a VASP.
Huh.
I mean, Mika's way ahead of us in the US. Well, you're not in the US currently,
right?
But
still got the passport.
Yes, exactly.
Okay, well, that is interesting. Good to understand that. Coming back to some of the other stuff that our two teams are working on TrueFi now. So, for anyone who's interested, you can go to forum.truefi.io. Team of Cicada just made a great post outlining bringing back a risk-managed crypto-native lending strategy to TrueFi by underwriting a lot of the crypto borrowers from the last cycle, whether that's the winter mutes or whoever else in the world of kind of crypto borrowers. And, I think as I kind of look through that, one of the, we've been talking to you guys since you launched Cicada, certainly wanted to bring you guys over from Maple, so we're very excited to do that. That said, I think one of the things that I find so exciting about this is that at the end of the day, for all of the hand-wringing people give towards lending to these crypto trading firms, it is the only sector that has really taken off in a meaningful way within on-chain lending, RWA, this whole category. You can look at RWA.xyz and there is one peak on the chart and it is TrueFi and Maple right up there. Mm-hmm. Today we're back at maybe a third of what that peak was. And whether or not crypto lending is kind of going to get us back there, to me, it is probably one of the most intelligent bets to take. So we're very excited by that. We've talked a little bit about it earlier, but presumably you guys could have done this off chain. You could have just set up a traditional fund. You could have tried to do this with all sort of the traditional infrastructure. We talked a little bit about it earlier, but maybe just to go over it again, what is it that gets you so excited about the on-chain aspect of this? Do you think it is, maybe more on the lender side, more on the borrower side? Who is this most appealing to?
Yeah, that's a good question. I would say it depends on the borrower, whether on-chain is attractive or not. But I'm hopeful that longer term, borrowers will pay a lower cost of capital by having greater transparency on-chain. So part of the ethos of Cicada is to drive volume on-chain using these protocols to ultimately, I think, create better capital markets. As we alluded to before, if 3AC was not handshake deals, OTC deals, they never would have gotten the access to the capital that they ultimately did, because sleuths on Twitter would just eat them alive. So that's from the borrower side of things. I think from the lender side of things, there's a couple interesting angles. I think one, ultimately, as I alluded to, like, I think the alpha opportunity here is substantial, but two, putting it on chain increases the possibility of having composability and risk transfer, and streamlining that process. I think really to drive more volumes back into the space, you need higher, we'll call them more institutional, higher quality lenders who want to take senior tranches. There's plenty of speculators who want to, earn 15 to 25% in an equity tranche. It's more about, like, can you get the sizable tickets to take the last, call it 80 to 90% of a capital structure. And I think DeFi all those primitives already exist. And so that's why I think it's interesting to put it on chain.
Relatedly, over the past 2 years, it's not like the CeFi platforms have kind of been sitting still, right? They've been growing their lending business in some cases, as we've kind of alluded to. Do you think the future is that a large crypto borrower is, sort of debating between using a TrueFi versus using one of these prime brokerages? Do you imagine that the prime brokerages partner with the DeFi protocols in some of these cases to be able to tap into the credit expertise like you guys are offering? Or how do you see that sort of shaking out in the next couple of years?
I think there's going to be a hybrid approach. I mean, I know we've had a number of borrowers tell us the limitations of prime brokerages tech stack. So that's one. More on the HFT side of market neutral trading. And then you have, maybe on the polar opposite side of the spectrum, you have more of the DeFi native funds that really won't touch any of the bigger prime brokerage players. So, and then you have the prime brokers themselves that are balance sheet constrained. And then the other native lender in the space that we haven't mentioned are the exchanges. And circle back to December really of 23, we started getting inbound directly from exchanges looking for capital at really kind of astronomical yields. That inbound really triggered us to, okay, now's the time to double click into and revamp the strategy and see where ultimately we can kind of add value during this next cycle, because we have the skill set to manage the risk. We understand the risks really well. We can originate fairly quickly because we have all the relationships. Now it's about how do we package it and bring it to DeFi.
Yeah, that's one of the things I guess I'm broadly kind of excited about too, which is I do think that the DeFi platforms like TrueFi offer this open, robust infrastructure to be able to accept capital, deploy capital, refund capital, all the things that we've talked about. In many cases, have the borrower relationships. The borrowers know how to interact here. And if there are these opportunities to plug into these more centralized platforms that are just looking to offer this to customers in some way, shape, or form, I do think that's probably an ideal outcome in many cases.
I mean, I guess it kind of collates with the whole like embedded finance meme in the fintech space. I mean, that's part of. I mean, going back to kind of some of the earlier topics, like that's kind of how I viewed a lot of these DeFi primitives circa 2 years ago. Now that obviously kind of hasn't panned out, but I don't think there's any sort of reason why they shouldn't, particularly given the open source nature of most of what DeFi is.
Yeah, in the past, Compound, I thought had tried this well with their Compound Treasury product, which was supposed to plug into kind of these neobanks and stuff, and just use the open source DeFi protocol, but have these APIs and a Fireblocks connection so that neobanks could offer this yield to their customers. It never took off in kind of the way that one would have expected, but when I think about the under-collateralized market, I don't think it makes sense to plug into the retail neobanks, but to plug into some of more of these brokerages and prime brokerages within crypto, that seems like more of a logical fit, and maybe something we'll be able to work on.
Yeah, I'd agree with that.
So, as we're kind of coming up maybe a little bit close to the end here, there's maybe 2 or 3 final questions I want to wrap up on. One is, what do you think is still misunderstood about this market today? I look around and I think the takes that I see from people, both as it refers to crypto lending and real world assets, are just so off the mark of what the reality of the market is today. I'd love to understand from you where you see some of that discrepancy.
Where do I start? I think we're getting. I think there's a couple from like a crypto native perspective. I think what's really misunderstood is a lot of the risk profiles of lending unsecured that we talked about before. I think from a very crypto native perspective, that's very clear to me. There's there's a willingness to accept token inflation as yield that's safe, but there's, I think, a misunderstanding of what true real yield is in crypto, and ultimately it's the supply and demand of money, which can conversely be also thought of as like funding rates. It's to a certain extent some staking yield. Beyond that, everything else is really a lot of token inflation. And so I think that's really misunderstood, and it gets back to a lot of the data that I mentioned earlier, being basic people clinging to some really bad, nefarious or poor capital allocation decisions on the side of a few people, but not the aggregate picture. Because it really takes a long time for us to actually aggregate all this data and understand, okay, what's the true picture of this? Whereas in TradFi markets, it's easy to just pull up a Moody's or S&P report, and you can kind of get the sense of, okay, what's probability of default and loss given default. So I think on the crypto native side, that's probably the most misunderstood. On the traditional side, I think there's a big misunderstanding on how risky DeFi is. I think if you unpackage what DeFi primitives and the attack vectors that they have that have resulted in the vast majority of exploits, you can get comfortable pretty quickly with things like TrueFi and other credit origination protocols that they're very safe to use. And I think obviously the proof is in the pudding. There's never been an exploit on a credit origination protocol. So we kind of walk between both the TradFi credit kind of side of the world as well as the crypto native. And I think we regularly run into those two kind of classic misunderstandings of risk, and just try and take as much time as you can to frame it better for people.
Would you say that those are also sort of the biggest blockers in terms of more adoption, just the sort of dual misunderstanding from both sides on the different topics? Or are there other structural things that this sector needs to work through to be able to demonstrate the value more?
Wallets, UX, it's just not good enough yet. I mean, I can very comfortably use a ledger after many years, but like the thought of teaching my sister, who's very tech savvy, how to use a ledger and how to interact with DeFi protocols it's a barrier that I think needs to be ultimately solved with like more of a Web 2 native approach, and it'll get there. It just takes time.
So looking ahead, there's the, ever elusive TradFi is coming. And actually just, recently with some of the BlackRock news and all, it does actually seem like that is happening. But perhaps in reverse, what impact do you think that some of the on-chain stuff that we're doing today, what impact could that have on the traditional system in the coming, God willing months, but realistically years?
It's a good question. I mean, insofar as like everything with the new Ethereum standards is tokenized, you effectively create a tradable asset. And if I go back to when I was working for an asset manager, the only thing they really cared about was tokenization and how that could ultimately result in secondary liquidity for existing strategies that are illiquid. So insofar as we're building the primitives to provide a better system to provide secondary liquidity for illiquid assets, I think, we're kind of building up that market for a TradFi audience. But I just think it's very early, and 90% of the tokenization memes are really more for C-suite executives than they are for actual real business growth, in my opinion, at least on the TradFi side for now.
Yeah, that's always kind of been my thinking too. I definitely put a giant discount on some of these, big asset manager apparently doing a thing on chain XYZ. And, when you dig into some of the numbers for those, one, they never actually get deposits. But two, I mean, are they really using blockchain in any kind of meaningful way, or is it just a simple deposit contract that gets off-ramped immediately? So point heard there. So as we come up on time here, is there anything we didn't cover that you would like to cover either in the crypto markets, what you guys are doing at Cicada, or anything else worth going into?
No, I think, we cover a lot here. It just maybe I can just give a shout out to our website if you have any interest in learning more about Cicada, Cicada.partners. We have a blog that we can get really deep into the intricacies of on-chain credit for those interested on Medium, and also not big Twitter users, but we have the default crypto Twitter account at Cicada Credit.
Awesome. Well, I definitely recommend that anyone who enjoyed this conversation go check out the Cicada Partners blog. They have a bunch of content around crypto credit, some of the things we talked about around default rates and quantifying some of the risks around smart contracts, all of that stuff. So, Sefton, thank you again for your time today, and looking forward to working with your team more from the TrueFi side as well in the coming months and years. So,
great. Thanks. It's great to be here, Ryan.
And
have a good day.
Talk soon.